My name is Patrick Kamau Kamure, and I welcome you to today's class. Today's lesson, subject that we are supposed to look at, is about public finance and taxation. Now, in the public finance and taxation, we are going to look at the topic of capital allowances, which is also called the investment allowance. So, when you talk of the capital allowance or investment allowance, it's good to make it very clear from the word go that this is a precursor to another topic that we are going to look at in a while, and I'm going to show you how it is connected to this topic of the taxation of the business income. Now, it's good to note that the capital allowance, as we compute it and in relation to the taxation, is usually used in place of something we call depreciation. Now, depreciation, you used to use it when you are doing your financial accounting or financial reporting. Now, when you are being taught about financial accounting and financial reporting, you are being taught to be an accountant. And now here, we are teaching you on how to become a tax person. So, for you to be able to connect, let us start from where you are using the depreciation in financial accounting and financial reporting. You remember this, you used to be given some information when you're doing your financial accounting and financial reporting, and you used to be told, like, prepare the profit and loss account or prepare the income statement. And when you are being told that way, you used to be given some information like sales, purchases, incomes, expenses. Then this is how you used to arrange your information to prepare the income statement or the profit and loss account. Here you used to come here and have the name of the business. Let us call this business ABC Limited. And then you used to come and say you want to determine the income statement. Income statement stroke profit and loss account. Profit and loss account. So for the period ended, you used to indicate, let's say 31st of December 20, you indicate there. You used to come and have, if you're given the sales, you write the sales here. Items are given, let's say, in shillings. So you used to come and post your sales there. And then you used to less cost of sales. And if you remember, although I don't want us to go into details, when you are getting the cost of sales, you used to say, let's say, opening stock plus purchases less closing stock minus drawings of the stocks by the owner of the business, and then you used to get the cost of sales, which when you took the sales minus the cost of sales, you used to get the gross profit. The gross profit there. And once you get the gross profit, you used to add incomes, other incomes. You used to call them other incomes. Other incomes. These incomes used to be discount receipt, come and place it there, investment incomes, you used to come and place it there, among other incomes that you could have been given, and then you used to less expenses. The expenses you used to deduct were like electricity expenses. You used to come and deduct them there. Salary and wages. You used to come and deduct it there. The rent expense. You used to come and deduct it there, among other expenses. But I want to remind you of one expense, and that is where we are today. The reason why we are doing this, and the capital allowance or investment allowance. Remember, if you are given if you are told that the business purchased motor vehicle, I want to write it here first, motor vehicle, and they purchased motor vehicle for 10 million. Now remember, when the business purchased the motor vehicle, they are incurring an expense, you know, they paid the 10 million. So this is an expense to the business. They have spent money. Being an expense, I'm very sure if you remember, you didn't used to say that because it's an expense, you come and deduct it here. That is not what you used to do. In financial accounting and in financial reporting, what you used to ask yourself is, this is a fixed asset. Fixed asset, when you purchase it, it assists you to run the business in the long term. So you used to ask yourself, how long am I supposed to depreciate this motor vehicle? And the depreciation of that motor vehicle is the one that you used to come and bring it here, not the whole cost of the motor vehicle just because they have purchased the motor vehicle. So if, for example, you are told that the motor vehicle was being depreciated at the rate of 10% per annum every year, then that means that every year they were supposed to take 10% of 10 million, and that translates to 1 million. So once you determine that depreciation of 1 million, in this case, you used to come and bring it in the income statement and say, I have another expense, which is the depreciation of the motor vehicle. And now since we have determined it's 1 million, you used to bring it here, 1 million. And once you do that, you used to get the net profit or loss of the business there. And that is how you used to do it. Now, that was the financial accounting, financial reporting, when you are being taught to be a financial accountant. Now, we are looking at the taxation. Now, we are going to realize in our next topic that at some moment we'll be required to prepare the same statement. But the profit that we'll be getting down here won't be called just the net profit or the net loss. Actually, we are going to realize that that net profit that you used to get is usually called net accounting profit or net accounting loss. Why accounting? The name accounting, it means that it was being prepared by an accountant. So in taxation, we normally call it net taxable profit or loss. That is the profit or loss that is supposed to be subjected to tax. So now, when we get there, where we'll be getting the net taxable profit or loss, instead of net accounting profit or loss, we will realize this depreciation that you used to have is no longer required. It's not the one that is supposed to be deducted. Here, we will note an item like a motor vehicle, you are supposed to compute something called the capital allowance. We used to have, we are supposed to compute capital allowance or investment allowance. Of which case we are going to realize for the motor vehicle, the capital allowance rate is supposed to be 25%. So you take 25% of the fixed asset like motor vehicle, 10 million, and that tells you that we have 2.5 million. So now instead of taking the depreciation here, when we are getting the net taxable taxable profit or loss, we will come and bring the capital allowance. Depreciation is not allowable. Capital allowance for the same motor vehicle. See now, it is not 1 million as per the way the accountant had determined. Now we have 2.5 million is the one that you come and deduct there. So now we want to see, this is just one fixed asset, the motor vehicle, of which case you determine the capital allowance the way you have determined so that you can come and deduct it here. How about in case you have other assets, like you have the furniture and fittings, you have the buildings, you have the computers, you have other items that are used in the business and which are supposed to assist the business in the long term. So how do you normally claim the capital allowance on them instead of depreciation, which was being determined when you are preparing the net accounting profit. So that is where now we are today about this topic of the capital allowance or investment allowance. So I hope you have understood it very clearly that the capital allowance or investment allowance is used instead of the depreciation, because depreciation is for accountant, not for the tax person, and it is usually computed in relation to the fixed assets like motor vehicle, furniture and fittings, the buildings, the computers and such. So now coming back to the capital allowance, we have said it is usually on fixed asset, and we have seen we have lot range of the fixed assets. It's good to know, as the rate we have said here about motor vehicle of 25%, now we have other rates which are applicable on other assets. Now when you are claiming the capital allowance, we usually have 4 rates which we are supposed to use when you are claiming capital allowance on fixed assets. I'm going to list those rates here, and then we are going to look at those items that we normally give the capital allowance at. Those rates I'm going to list. Like the first one, which are the items do we give the capital allowance at that rate? You go to the second rate, which items do we normally give capital allowance at that particular rate? The third one, the fourth one, that way. So these rates are rates for capital allowance. So these are the rates. We have number 1, capital allowance at the rate of 50% in the first year of use, and then 25% per annum straight line basis from the second year on the remaining balance. Number 2, capital allowance at the rate of 25% per annum straight line basis. Number 3, capital allowance at the rate of 10% per annum straight line basis. Number 4, capital allowance at the rate of 33.33% into brackets, we call it a third per annum on costs straight line. Basis. So when you talk of the capital allowance, these are the rates that we normally use to claim capital allowance on the fixed assets that are used to run the business. So the next thing that we need to learn is when we talk of the 50% and then 25%, what do we mean? And once we understand what we mean, then in that case, then we look at which are the items that we normally give capital allowance at that rate. We go to the 25%, we do the same. The 10%, we do the same. and 33 and a third percent or a third, we do the same. So I'm going to start with the first one. So I write it as the heading, and then we look at what do we mean by it, and then which are the items we normally give the capital allowance at that particular rate. So come. So here we are, the first rate for capital allowance. Capital allowance at the rate of 50% in the first year of use, then 25% per annum straight line basis from the second year on the remaining balance. What do we mean by that? Now, before we look at the items that we give capital allowance at those rates, this is what it means. It means when you have an item that we are supposed to give the capital allowance at that rate, first year, take 50% of the cost. And when you take that 50% of the cost, when you are determining the taxable income of that year, the taxable income, the income to be charged tax for that particular business, and you are preparing the statement I had indicated here. So the amount you are supposed to come and put here in relation to that asset, you take 50%. And when you talk of 50%, it doesn't matter of when it was acquired. If it was acquired at the beginning of the year, in the middle of the year, one day to the end of the year, it doesn't matter. As long as it was used in that year, you take 50%. And then that will mean that when you talk of now 25% per annum straight line basis from the second year, now from the second year you'll be taking 25% of whatever remain after you have claimed the 50%. And then it should be every year per annum. Per annum means per 12 months. So if, for example, you have reached the second year and an item is sold during the year, for example, in the second year you use it only for 6 months because it is disposed of. In that case, you are going to take 25% times 6 over 12 because the 25% is per annum. Per annum means per 12 months. But take note, for the first year 50%, we haven't said per annum. So in that case, it's going to be 50% period without considering the period it was used. That will mean if we have an item here, let's say it costed 100 million. It costed 100 million. Then somebody tell you that it is the one that qualify, although we are going to see those items that qualify at that rate, and somebody tell you that it qualify at the rate of 50, then 25, the rate that we have indicated there, and now ask you, can you get the capital allowance of the first year? So you'll come and say, ask this person, when was it acquired? Let's say the year we are considering is 2022, the 2022, and then you are told it was acquired on 1st of July 2022. Now, 2022 become the first year. So the capital allowance for the first year is going to be equivalent to, we have said, 50% of 100 million, without considering that it was used for just part of the year, which will give you the 50 million. So 50 million is the one that you're going to take to the income statement when you're getting the taxable profit and deduct it here in 2022. Then if somebody asks you, how about the capital allowance of the second year? How much is it going to be? Now the second year must be now the 2023. You'll come and say the capital allowance for the second year, which in this case we are talking about the 2023. If it was used the whole of 2023, it is going to be, we have said 25% per annum on the remaining balance after the first year. So how much remained after the first year? So the cost was 100 million. The first year capital allowance, 50, is what was claimed. That means that the remaining balance is 50 million. Then if you take 25%, that is going to be 12.5 million. So in the 2023, when you are determining the taxable income of the business, you'll come and bring it here. How about in case somebody asks you about the capital allowance of the third year? The third year, in this case, that means 2024. How much will it be? In this case, we have said 25% straight line from the second year. That means that you take 25% again of per annum of the remaining balance after the first year. Remember, the remaining balance is after the first year. So you do the same as we did here. So the cost was 100 million, but the first year we claimed 50 million. So minus 50 million. So the remaining balance is 50 million. So when you take 25%, that is going to be again 12.5 million. So when you are getting the taxable income of the second year, you are going to take again 12.5 million of 2024 when you are preparing the statement. How about in case somebody tell you now, in the fourth year, this asset was sold mid the year. Let's say now we are talking about 2025. It was sold by 30th June of 2025. So how much will be the capital allowance? The capital allowance will be, that is now for the fourth year, and that is supposed to be 2025, is going to be equivalent to 25% per annum. Remember we said per annum means per 12 months, per year for 12 months. So now that it was sold during the year, by 30th June 2025, that means that it was only used for 6 months in that particular year. So in this case, when you talk of 25% per 12 months, now for the 6 months is going to be what? You multiply by 6 over 12 of the remaining balance after the first year. So the remaining balance of the first year was, the cost was 100 million minus what was claimed in the first year, that is 50 million. So you are left with 50 million. So when you take 25% of 6 over 12 times 50 million, this is the amount that you are going to get. So we will have 25%, you multiply by 6 over 12, 6 over 12, and then you multiply by the remaining balance after the first year, 50, and that is going to give you 6.25 million. And that is the one that you are going to take to the income statement when determining the taxable profit of the 2025. That is supposed to be the fourth year when you are getting the taxable profit there. So take note, the reason why we have said times 6 over 12 of 25 is because it was sold during the year of 2025. It was sold by 30th June 2025, meaning it was only used for 6 months. And because you are saying 25% is per annum, then you have to apportion it based on time. So that is what we mean by capital allowance at the rate of 50% in the first year of use, and then 25% per annum straight line basis from the second year on the remaining balance. Now, having noted on how we apply the rate of 50% and then 25%, the second question we should be asking ourselves is, which are those items that qualify for capital allowance at that particular rate? So that now, like now we have been using the 100 million to explain what we have explained here. Which this item was acquired at 100 million, the one that we should be claiming capital allowance at the rate that we have talked about. Which are those items? So that if you are given like 30 items, you know that this one is supposed to be under this rate. The other ones, maybe they are supposed to be for another rate, or they do not qualify for any capital allowance. So now we look at the items that qualify for capital allowance at the rate that we have talked about. So we have items qualifying for capital allowance at the above rates. What are those items? Items qualifying for capital allowance at the above rates are, number one, the following items: used in manufacturing. The key thing I want you to get from there, and these are the ones that we'll be using, these are the headings we'll be using to understand, is the term manufacturing. Manufacturing. So when a business is doing manufacturing and it incur the cost on the items I'm about to list, then they should claim the capital allowance at the rate of 50% in the first year, then 25% per annum straight line basis from the second year on the remaining balance. These items are A, factory building, stroke industrial building, and the costs incurred that assist to use the building. To use factory stroke industrial building. Such as we have parking area, sewerage system, railway lines, electricity system, water systems, we have tunnels, bridges, etc., among others. So what we are saying is that if you are doing manufacturing, and you can see we are calling it the factory building because factory building, its purpose is to be used for manufacturing, or an industrial building, its work is to be used for manufacturing. So when you have the costs that were incurred to put up that building, give that cost the capital allowance at the rate we have indicated. We didn't stop there, but we also said also the costs incurred that assist to use the factory or industrial building. So there are those costs that are incurred in the process of using the building, or that are incurred in order to support the usage of that particular factory building or industrial building that has been set up. These costs are like parking area. You see, if you set up a factory building and you don't have somewhere somebody can come and park a lorry where goods can be now loaded into the lorry and be taken to the market, or if it is the raw material can be off-roaded, that building cannot be effectively be used. So you may realize you require a parking area. Another one is the sewerage system. So if you don't have a sewerage system in the factory, you may find that the waste product may not be eliminated from the factory system. So it will become kind of an issue. Another one are railway system, the electricity system, water system, tunnels. There are some factories which are usually connected through tunnels so that they can allow people to move from one part of the factory building to another part of the factory building, or from one factory building to another factory building. Others normally have bridges connecting them. All this is for the purpose of using that particular factory building. All those costs, when they are incurred, we normally give them the capital allowance at the rate of 50% in the first year, then 25% per annum straight line basis on the remaining balance from the second year. That is number one under manufacturing. Number two under manufacturing, B. We have the machine used in manufacturing, and machine that assists manufacturing, including cost incurred before, the use of machines. So we are saying those machines that are used in manufacturing, including costs incurred before use of machine. The key things are these ones. Machines used in manufacturing, although I'm going to list them in a while. But here we are talking about used in manufacturing, like a processing machine. Processing machine is used to convert the raw material into the finished goods. That is one of the machines that is used in manufacturing. Not only that, but also machines that assist. The key thing assist in manufacturing. That means that these machines are not directly used to convert the raw material into the finished goods, but they help for that process to continue. And here we are going to look at some of those machines, but you can imagine one of them being like a water pump. Water pump is used to pump water into the system of the factory. So that means that water pump is not itself used to convert the raw material into the finished goods in the manufacturing, but it assists. Without pumping that water, the manufacturing cannot continue. So in this case, we are saying that those machines that assist in manufacturing also qualify for the rate we have talked about. Not only that, but also cost incurred, the cost incurred before use of those machines. This I'm going to list in a while, but they mean that you are incurring or you incur some cost before you started using a machine. A good example is you can purchase a processing machine, and maybe you purchased a processing machine through importing it, so you didn't find it locally, so you bought it maybe in Europe. Now when you buy that machine, it cannot be of any use. You can be told pay 50 million and you pay, but unless you transport it, it comes into your factory, you install it, it cannot help you. So you may incur 50 million, that is the cost of machine, yes, but now you need to transport. Out of 50, you incur an extra 5 million to transport it. That's 55 million. When you are transporting, you are told by the transport company, you have to insure your machine. Maybe you insure for 2 million. You know, that's 57 million. So, and then when you bring it into your factory, you realize that you need to install it into your factory system so that it can be of use. So you hire an expert to come and install the machine for you, and this person tell you pay 3 million. In total now that is 60 million. So in this case now, when you are claiming capital allowance on that machine, you won't claim on the 50 million only. It will be 50 million plus the 5 million transport, plus the 2 million which was incurred insurance, plus the 3 million that was incurred to install that particular machine. So all those costs are put together and used to claim capital allowance on these machines that we have talked about here. So I want to give you examples of these machines. So we say example of these machines are, so these are the one, processing machine, we have water pump, packaging machine, conveyor belts, we have treatment plants, generators, etc., among others. As long as a machine is used in manufacturing or that assists in manufacturing like this one, you normally give it the rate we have talked about. I also want to give you a list of the expenses that could have been incurred before the machine was used, which you normally add them together when you're claiming capital allowance on that particular machine. So on the same, costs incurred before use are, these are the costs, are, we have transport, insurance, loading and off-roading costs, we have the installation costs, testing costs, etc., among others. But the key thing before use of those particular machine. Any, it can also include cost like repair. As long as it is incurred before use, we put them together when you're claiming capital allowance at the rate we have talked about the machine. But those costs that are incurred after you start using the machine, those do not qualify for capital allowance. We don't include them together with the machine when you are claiming capital allowance. Now we go to the third items that we normally give capital allowance at the rate of 50, then 25, as we had illustrated. This one is the C.
Welcome back to this session. Now we are doing question 5 of the same paper, that is September 2021. So question 5A says, your country has been experiencing growth in the number of projects initiated through public-private partnerships, PPPs. However, this growth appears to be declining in the last few years. Your country has been experiencing growth in the number of projects initiated through public-private partnerships, PPPs. However, this growth appears to be declining in the last few years. Required. Evaluate the possible factors that could have contributed to this trend. Evaluate the possible factors that could have contributed to this trend. Now, the topic being tested here is public-private partnerships, PPPs, a topic in our syllabus, that is Advanced Public Finance and Taxation. Now, you need to understand what a PP is. You need to understand, how to finance a PPP project and all that. Now, just a brief introduction to that. A PPP, or rather, that is a public-private partnership, is simply an arrangement in which a private party undertakes to provide a service or to undertake a project on behalf of a public entity, where the private party is compensated by the public body, and it also bears the risks and responsibilities associated with the project. So say, for example, the government of Kenya wants to maybe put up a given number of houses for the citizens. It can engage or rather enter partnership with a private body or a private institution to do that on its behalf. So say, for example, the Ministry of Housing engaging or entering a partnership with a private developer to build the houses on behalf of the ministry. So in that case, the private developer is responsible for the risk and responsibility associated with the project. Number two, it will have to be compensated by the public entity that is engaging it. Now, the question here is, we evaluate possible factors that could have contributed to this trend. What trend? The trend is, the declining rate of PPP projects in the last few years in Kenya. There are many reasons why there has been a decline, a notable decline in the number of PPP projects undertaken in Kenya. One is political interference. Now, we all know that politicians are normally interested in a lot of projects because of financial gains and all that. So one of the challenges facing PPPs in Kenya, PPP projects in Kenya, is the issue of political interference. If, for example, you look at your constituency, you'll at least identify a project that was initiated by the former NP. And now that there is a new MP, they're not very keen to complete the project so that it can benefit the citizens. That is one. Number two is what we call inefficiency in the public sector. So rather, you can put it like this: lack of capacity to select, procure and implement PPP projects. So the government or other participants in the PPP projects may not have the required capacity to select keenly the relevant projects, procure these projects at reasonable costs, and implement them to benefit the citizens. Three, there is lack of clarity with respect to formal and contractual arrangements or engagements in PPP projects. That is, it sometimes is not very clear that who is to do what in a given PPP project. So that ends up leading to confusion that leads to the failure of PPP projects. Another possible challenge facing PPP projects is poor governance, like poor leadership. There's no proper leadership to spearhead the PPP projects on behalf of the government for the benefit of the citizens. Another one is poor product design and structuring. Nobody is keen to design the projects keenly so that they are sure the project can be viable and can benefit the citizens in the long run. So that is another possible challenge facing PPP projects in Kenya. Another one is misprioritization, that is misplaced priorities. So a project is undertaken, yes, to benefit the public, but then it is not, for example, an immediate need of that particular location. So, for example, you find the government implementing Project X in a given community, yet the community is not in need of Project X. They are more interested and they would benefit more from Project Y. So then there could be cases of misprioritization in the implementation of PPP projects. So those are the possible challenges that may have led to the collapse or the decline in the rate of PPP projects undertaken by the government in Kenya. That was part A of question 5. I want us to move to question 5B, which says, the following information was obtained from the financial records of Alemao Commercial Bank Limited for the year ended 31st December 2010. The following information was obtained from the financial records of Alemao Commercial Bank Limited for the year ended 31st December 2020. So we have interest on advances, contribution to deposit protection fund, operating lease rentals, interest on government securities, interest paid on deposits, interest on placement and bank balances, loss on disposal of collaterals, fees and commission expenses, losses from investment in securities, purchase of equipment, depreciation, transfer to statutory reserves, losses on stock brokerage dealings, gain on foreign exchange dealings, discount on bills purchased, auditor's remuneration, provision for bad and doubtful debts, investment in government securities, bills receivable for collection, guarantees and performance bonds, interest accrued and paid, bills for collection, acceptance and endorsements, rebates on bills discounted, provision for taxation, general charges recovered, and commission on exchange and brokerage. Additional information 1. Contribution to Deposit Protection Fund includes investment revaluation surplus of 972,000 shillings. Now, this is a question on taxation of banks. That is under the topic Advanced Aspects of Taxation of Business Income. Now, we need to remember the key rules in taxation of banks. Now, one, a bank is a company just like any other company. So, depending on its residence, it can be taxed at 25% or 30% currently, or any other applicable rate for non-resident companies. Now, number 2 is that in a bank, the main item of trade is money. And this money has to be secured. It has to be protected. And therefore, a bank will spend to buy insurance, or that to insure the money against theft or any other risk. And so, every bank will always contribute, or rather make contributions to what we call deposit protection fund. Now, the amount contributed by a bank to a deposit protection fund is equivalent to insurance, and therefore it is an allowable expense for tax purposes. But here we are told that from the question, total contribution to deposit protection fund is 147 million shillings. But we are told that includes an investment revaluation surplus of 972,000 shillings. So it means only the difference between the two will be an allowable expense as insurance or contribution by the bank to the Deposit Protection Fund. 2. Included in transfer to statutory reserves is an amount paid for exchange and commissions of 72,000 shillings. Included in transfer to statutory reserves. Now, an increase in a reserve or the contribution to a reserve is not an allowable expense for tax purposes. But then we are told in the question, in transfer to general reserves is a total of 937,000 shillings. But we are told that includes an amount paid for exchange and commission of 72,000 shillings. So we shall only allow the 72,000 shillings, which was an expense on exchange and commissions. Now you know that banks work through agents and all that, and they have to pay commissions to such agents and all that. So that is an allowable expense for tax purposes. Next, provision for bad and doubtful debts include specific bad debts at the beginning and at the end of the year amounting to 1,000 or 2,000 shillings and 210,000 shillings respectively. Provision for bad and doubtful debts include specific bad debts at the beginning and at the end of the year amounting to 102,000 shillings and 210,000 shillings respectively. Now, in taxation of a bank, an increase in a provision is an allowable expense and a decrease in a provision is a taxable income. So let's be keen on this. We are told at the beginning of the year, the provision for specific bad debts was 1,000 or 2,000 shillings. At the end of the year, it is now 210,000 shillings, meaning there was an increase of the difference between the two. 210 less 102 should be 108, and so that 108,000 shillings will be an allowable expense. Discounts on bills purchased include interest and discount paid of 58,500,000 shillings. These discounts on bills purchased include interest and discount paid of 58,500 shillings. Now, we know that one of the activities of a bank is discounting of bills and all that. Now, if a bank is buying bills or purchasing bills and it gets a discount on the same, that would be equivalent to discount received, which is a taxable income. But here we are told, now according to the list provided, discount on bills purchased is a total of 493.5. That is 493,500. But we are told that includes an interest and discount paid of 58.5 shillings, 58,500. So what we shall do is simple. We shall include the 58,500 as part of the discount received, or the discount on bills purchased, to get the total discount received. Lastly, note 5, the corporate tax applicable during the year was 25%. It means to get tax liability, we shall simply multiply the corporation tax rate by the reported, or the determined net profit. So then we can work it out keenly and get the taxable income. So we write here Alemao. This is question 5B, sorry. Alemao Commercial Bank Limited. We are working out taxable income computation for the year ended 31st December 2020. We can carry the 3 zeros to ease in our work. So here we are using the net profit, sorry, the gross profit approach, because we do not have a reported net profit. We use the gross profit approach. So we identify the taxable incomes, list them here, get total income, then we deduct the allowable expenses. Now, the main income of a bank is interest. So and then the main expense is also interest. So we have to be very keen and identify the interests that are incomes and separate them from those that are expenses. So we have to be very keen when doing that. So one, in the list we have interest on advances. So that is an income, not an expense, because it means this bank advanced loans or facilities to its customers, then charge them interest. So that interest is an expense to the customers, to the account holders that is, but then an income to the bank. So we write here interest on advances. Interest on advances. A total of 697,200. Next item is contribution to deposit protection fund. That is an expense. We shall come back to it. Operating lease rentals, an expense. We shall come back to it. Interest on government securities. Now that means this bank has bought government, or rather has invested in government securities. So the government has paid it interest. So that becomes an income. We add it here. Interest on government securities. A total of 21,900. Next we have interest on placement and bank balances. Interest on placement and bank balances. Now a bank A can place or have an account with a different bank B. Say for example, Equity Bank having an account with KCB. So it means KCB will have to pay interest to Equity Bank. So then that becomes an expense to KCB, but an income to Equity Bank. So then this is an income to this bank. We add it, we call it interest on placements and bank balances. Bank balances. A total of 339.90. Next we have loss on disposal of collaterals. That is an expense. We shall come back to it. Fees and commission expense, an expense. We come back to it. Losses from investment in securities, still an expense. Purchase of equipment, an expense, though capital, we shall come back to it. Depreciation is an expense. Transfers to statutory reserves, not an income, we shall come back to it. Losses on stock brokerage dealings, that is an expense. Next we have gain on foreign exchange dealings. Gain on foreign exchange dealings. Now, it simply means this bank is operating in the foreign exchange market. And we know that a gain on foreign exchange dealings is only taxable if realized, but non-taxable if unrealized. Now here, because they are silent, we can make an assumption either way. So if we assume that these gains on foreign exchange dealings have been realized, then it means there will be a taxable income. But if we assume they have not been realized, then it means they will not be taxable. So in our notes and assumptions, we can assume in this case that the gains on foreign exchange dealings are assumed to have been realized, hence taxable. Now in exams, please don't make an assumption without writing it down. Provided you make an assumption, ensure you write it down under notes and assumptions. So here we are assuming this is realized and therefore taxable. So then we include it here. We say gain on foreign exchange. Gain on foreign exchange dealings. A total of 2205. Next we have discount on bills purchased. a total of 493.5. Then we have note 3, which says discount on bills purchased include interest and discount paid of 58.5. So we have to adjust that. We say discount on bills purchased. Now we need to understand discount on bill purchase is an income. The reported amount here is 493.5. But then note 2 says, sorry, note 3, discount on bills purchased include interest and discount paid of 58.8. Now, interest and discount paid is an expense, is an outflow. But then discount of bills purchased is an income. So it means the reported income is less the expense that was paid out of it. So then to get the total expense, we get the sum of the two. That is 493.5 plus 58.5. We work it out together. 493.5 plus 58.5, a total of 552. That is what we write here. Next, we have auditor's remuneration for a company that is allowable. Next, we have provision for bad and doubtful debts. We shall come back to that. We have investment in government securities. Now, investment in government securities is not an income, it's not an expense, but an asset. So we don't use assets when working out taxable income. Bills receivable and for collection are still an asset. Guarantees and performance bonds still an asset. Interest accrued and paid is an expense. We shall come back to it. Rebate on bills discounted. Now, a rebate on a bill discounted is simply an earned interest or an earned discount. Now, because it is an earned, we cannot tax it, so we leave it out. Provision for taxation is not an allowable expense. We shall not use it here. General charges recovered is an income. We know if you are a client in a bank, the bank is likely to charge you for certain services. For example, certain banks charge what they call ledger fees, they charge account maintenance fees and all that. Now, that is an expense to you as the account holder, but an income to the bank, and so it is a taxable income. So we call it general charges recovered. A total of 375. The last item is commission on exchange and brokerage. That is an expense. And we don't have any other income, even in the additional information. So what we do is to get total income by summing up all this. Total income. So we get the sum of all this. Be very keen. 690, 697, 200, 21, 900, 3990, 2205, 552, and 375. A total of 726,222. Next step, we go to allowable expenses. You only pick those that are allowable. So you say less allowable expenses. So you analyze the expenses and only pick those that are allowable. We start. One, we have the contribution to deposit protection fund, the insurance that I was talking about. The total is 147,000, but then we have note 1, which says contribution to deposit protection fund includes investment revaluation surplus of 972,000. So then we only allow the difference, that is 147,000 less 972,000, that is 825. So we write here contribution to deposit protection fund 825. Next we have operating lease rentals, that is allowable. In business, you can lease assets or a building from a third party, and the lease rentals you pay to them becomes an allowable expense in your books. So we write here lease, operating lease rentals. Yes, operating lease rentals. Operating lease rentals, a total of 9720. Next we have interest on government securities, that is an income. Interest paid on deposits, that is an expense to the bank. Like you fix X amount of shillings with the bank for 1 year. The interest rate is 5%. At the end of the year, the company pays you 5% of X. So that is an expense to the bank. So a total of 7110. Interest on deposits. Interest on deposits. 718. Next we have loss on disposal of collaterals. That is an allowable expense. By the way, remember, for a bank, we have what we call the specified sources of income clause. Now, for a bank, the specified sources of income clause is not applicable. Now, the specified sources of income clause says that where a taxpayer has 2 or more sources of income at the same time, a loss from one source of income cannot be offset against the income from other sources. But for a bank, that rule does not apply. So it means, for example, if a bank has 2 sources of income and realizes a loss from source 1, that loss can be offset against income from source 2. So then this becomes an allowable expense. Loss on disposal of collaterals. A total of 1260. Next we have fees and commission expense, allowable, very common for a bank. Fees and commission expense. A total of 2130. Next we have losses from investment in securities, an allowable expense for a bank. Loss from investment in securities. A total of 1185. Purchase of equipment is a capital expenditure which is disallowable for tax purposes, but we shall allow for capital allowance. So purchase of equipment is the only capital expenditure in this question. So what we do, we can get the capital allowance even right now. Capital allowance. You go back to the table in the front page of the paper. You look for equipment. You have to be very keen and know what is relevant to a bank. We are determining taxable income of a bank. So if you look at the page, the table provided there, we have a number of machinery, different classes of machinery. We have machinery used for manufacture, machinery, hospital equipment, and all that. But for a bank, what is more relevant is telecommunication equipment, which attracts wear and tear at the rate of 10% per annum on reducing balance. So we simply take 10% of the cost of this equipment, and the cost of the equipment is 1.8 million. So 10% of 1.8 million is 180,000. Next we have depreciation. Now we know depreciation is disallowable for tax purposes. Instead, we allow for capital allowance. Transfers to statutory reserves is a disallowable expense. But then we have note 2, which says, included in the transfer to statutory reserves is an amount paid for exchange and commission of 72,000 shillings. So we do it like this. Total transfer to statutory reserve is 939,000. So we do 939 less, sorry, total transfer to statutory reserve is 939, but then 72 out of that was an amount paid for exchange and commission. So the 72 is allowable, but the difference is not allowable. So we only take that, we call it exchange and commission. Exchange and commission. 72. We continue from here. Next we have losses on stock exchange dealings. A bank deals in stock exchange, so that loss becomes an allowable expense. And it is because I've said the specified sources of income clause does not apply in taxation of banks. Loss on stock brokerage dealings. A total of 522. Next we have gain on foreign exchange dealings. That is an income. We had taken care of that. Next we have auditor's remuneration, an allowable expense in business. A total of 1179. Provision for bad and doubtful debts is a total of 810. But then we have note 4, which says provision for bad and doubtful debts include specific bad debts at the beginning and at the end of the year, amounting to 1 or 2,000 and 10,000 shillings respectively. Now, we said that for a bank, an increase in a provision is an allowable expense, while a decrease in a provision is taxable income. So what we do here is simply to get the difference between 210 less 102, that is 108. So we write here increase in provision for specific bad debts, a total of 108. Next we have investment in government securities, that is an asset. Bills receivable and for collection, an asset. Guarantees and performance bonds, an asset. Interest accrued and paid is an allowable expense for a bank. Interest accrued and paid, a total of 2961. We have provision for taxation. Provisions for taxation is not an allowable expense. General charges recovered is a taxable income. We have dealt with that. Then we have commission on exchange and brokerage as an allowable expense. So commission on exchange and brokerage, a total of 1176. And we have also taken care of all the additional information from 1 to 4. But 5 says the corporate tax rate applicable during the year was 25%. So what we do is to get total allowable expense. So we do it together. 825 plus 9720 plus 7110 1260 2130 1185 180 72 522 1179 108 2961 and lastly 1176, a total of 28 428. We deduct that from the total income, which we got to be 726,222. So we do 726,222 less 28,428. We get 697,794. You double underline to mean it is the end of the equation, and we call it taxable income. Taxable income. From there, we can go ahead and work out the tax payable. So we do part 2 of the question, tax payable. Now, we are told in note 5 that the corporate tax rate applicable during the year was 25%. So it means tax payable will simply be 25% of 697,794. We can now include the 3 zeros times 2, and we get 174,448,500, and that is the end of the question. So that marks the end of question 5 and the end of the September 2021 sitting. Thank you. You can go through the work again and make sure you get each and every concept. Thank you, and see you in the next session.
Hey there, my name is Patrick Kamau-Kamure. You are a lecturer in public finance and taxation. Welcome to today's lesson where we learn more about the taxation of the business income, and which we started some times back in few lessons, past lessons, where we say that we are supposed to look at the taxation of the business income, and we had 3 businesses we are supposed to look at: the sole proprietorship, partnership, and the limited company. In our previous lessons, we have covered the sole proprietorship and the partnership. So what is remaining is the taxation of the limited company, and it is the one that I want us to look at how it is usually taxed. So this is what you need to know about the limited company. That limited company is considered to be a separate legal entity from the owners, and therefore taxed on its own income and therefore taxed on its own income at corporate tax rate. That is the first thing that you need to know, that a company is considered to be separate from the people who forms it. So when you're taxing a company, you tax the company itself. You don't tax the owners. Unlike the case of sole proprietorship, which you tax the owner, the partnership where you tax the partners, here you tax the company itself. So the following points are considered when you are taxing the company. So points considered in taxation of a limited company. There are only 2 points that you need to consider when you are taxing a company. One of them is this. 1, or A, a determination of the taxable income of taxable incomes. So this is determined using either number one, gross profit method, number two, net profit method. So what we are saying here is that when you are determining the taxable income of a company, you just determine it in the same way as any other business, the way we have been using it. Either gross profit method, if you have not been given net accounting profit. If you have been given the net accounting profit, then you use the net profit method. It's the same thing. Point B to consider is that taxable income of company is taxed at the following tax rate. One, resident company, 30%. Number two, non-resident company, 37.5%. But note, so what we are saying is that when you determine the taxable income of a company, if it is a resident company, you tax it at 30% to get the tax to be paid. If it is a non-resident company, that's 7.5%, then you get the tax to be paid. But note, from 1st of January 2024, non-residents will be taxed at 30%. Yeah. So there was a change of the law on 1st of July 2023, which stated that come January 2024, the non-resident corporate tax rate will be reduced from that 7.5% to 30%. So it's good to know when you are taxing a company, which year is it rating to? Any year before 2024, that is 7.5% for non-resident only. And now beyond 2024 or 24 and beyond, then it's supposed to be, that is 30%. That is all that you need to know. Otherwise, everything else that we have been talking about taxation of a business, in terms of the method, in terms of the taxable operating income, non-taxable operating income, allowable expenses, and non-allowable expenses remain the same. So now we look at a question. This is what the question says. Zahari Processors Limited presented the following statement of profit or loss for the year ended 31st December 2022. We have the turnover, cost of sales, gross profit, other incomes, provision for foreign exchange gain, gain on sale of motor vehicle, release of liability, refund of excess duty, investment income gross, total income, less expenses, purchase of trademark, a design of company website, director's fee, donation to charitable institutions, depreciation expense, marketing expense, management and professional fees, general expenses, legal costs, loan repayment, allowance for doubtful debts, impairment loss of property, a net profit for the year. Additional information number one. On 1st April 2022, the company acquired the following assets: factory building, warehouse, processing machinery, rolling 4 tons, drainage system, saloon car. Number two, management and professional fee comprised development of strategic plan, tax consultancy fee, audit fee, environmental assessment fee. General expenses include installation of neon sign, car grant to a director, installation of processing machine, staff Christmas party, retrenchment costs. Number four, legal fee comprised defense against claim for breach of trade agreement, renewal of Kenya Association of Manufacturers membership fee, negotiating a bank loan, a preparation of employment contract, drafting lease agreement 60 years. Number 5, release of liability was in respect of a loan obtained from one director who decided to write off the loan as it was due for over 4 years. So we are required compute the total taxable profit or loss for Zahari Processors Limited for the year ending that 1st December 2022. So we want to get the taxable income. First thing that we need to ask ourselves, which method are we supposed to use? It's obvious that for this question we are supposed to use the net profit method because we have been given the income statement with net profit, but the key we have been given the net profit, or if we are given the net loss or net income, is the same. So we'll start. So we'll start with the net profit that has been provided to us. Which we have, note that the items have been given shillings 1,000. So we have 527, 614. And then we add non-allowable expenses. In P&L and taxable operating income, not in P&L. So, as we have been doing any question that we use the net profit method, we just need to go to the P&L, look for the non-allowable expenses there. The first expense in the P&L, purchase of trademark. Trademark is not allowable. The first expense in the P&L is trademark, which is not allowable. So we add it. Then we continue. The next one is design of company website. Website is a fixed asset which we should claim capital allowance later. It's not allowable. So we add it, which we have 12,400. The other one is director's fee. Director's fee is allowed if you look at what we had said among the allowable expense initially. Donation to charity, that's allowable, we said. Depreciation, no, that is not allowable. Depreciation, which we have that 240. After the depreciation, marketing expense. Marketing is allowable. A management and professional fee, that is also allowable, we say, because it's for the business. General expenses, they are allowable because they are for business. Legal costs, unless it is stated what it is, it's allowed, which we had already looked at the non-allowable legal cost. Loan repayment, no, that isn't allowable. Loan repayment, which you have 2,600. Then the next one is allowance for doubtful debt. Allowance for doubtful debt is not allowed. It's a provision. Unless they say specific allowance, it's not allowable. Which we have 2,250. The next one is impairment loss of property. We don't allow impairment loss. We don't. So impairment loss, which we have 1,500. Seems we are done with non-allowable expense in P&L, but we need to go to the additional information, check if there is further analysis of expense in the P&L, and if there is a part that is not allowable. At the same time, in the additional information, we look for taxable operating income not in P&L. An income that is taxable and is operating but has not been included in the P&L up here. So let's see. Additional information number 1. On 1st April 2022, the company acquired the following assets. Now, those are fixed assets. First, they are not in the P&L. If you go to the P&L expenses, they are not there. So ignore. Number 2, management and professional fee comprised. Now that is in the P&L. We have to look for non-allowables. Higher development of strategic plan. That is an allowable expense because when you plan for your business, it's income generating, it's allowable. How about tax consultancy fee? No, anything to do with tax we don't allow. Tax consultancy fee, which you have 208. The next one is audit fee. Audit fee is allowed. Environmental assessment fee, that is supposed to be an allowable expense. Why? It is not income generating. We said any expense that is not income generating is not allowable. So environmental assessment, which we have 256. After that, we go to number 3. General expenses include. Now, general expenses is in the P&L. When you go to the P&L, you find the general expenses there. They include installation of neon sign. Neon sign installation is a fixed asset. Expense incurred before you start